A calculator sits on a sheet of paper. On the paper are investment and return amounts with a handwritten note that asks, "Can we do this?" Exhibit 14. 1. Credit, Mad Flickr / attribution 2. Generic, CC by 20. Learning outcomes. After reading this chapter, you should be able to answer these questions. Why are financial reports and accounting information important, and who uses them? What are the differences between public and private accountants, and how has federal legislation affected their work? What are the 6 steps in the accounting cycle? In what terms does the balance sheet describe the financial condition of an organization? How does the income statement report a firm's profitability? Why is the statement of cash flows an important source of information? How can ratio analysis be used to identify a firm's financial strengths and weaknesses? What major trends affect the accounting industry today? Exploring business careers. Theresa Lee. Future glory. Theresa Lee always knew she would start her own business. It was just a matter of time. In 2013, after working as a designer in the Bay Area for more than a decade, Lee co-founded Future Glory, which specializes in handmade leather bags and accessories, now made in a small studio in the Dogpatch neighborhood of San Francisco. Lee would be the first to tell you that she is a creative person and not so great with numbers and other business details. But the business details, including financial statements and cash flow, are key to any company. That's where accounting software like QuickBooks Online comes in handy. QuickBooks is a global online accounting program that has helped tech-savvy entrepreneurs take the worry out of crunching the numbers that can make or break their business ventures. Intuit, the global leader in accounting software, has revolutionized the approach taken by small businesses with its products, including QuickBooks and TurboTax, programs that can be used by new businesses, independent contractors, product sellers, accountants, and other types of businesses. The company estimates more than 2 million global customers are currently using the online version of QuickBooks. Intuit provides online support that includes expert help, a resource blog, accounting advice, and other features utilized by QuickBooks users and those wanting more information about how to track typical business accounting functions. As Lee points out, using a cloud-based accounting program has helped her gain control over company finances and provided insight into key business components such as profit and loss, cost of goods sold, and labor. In addition, QuickBooks' ability to work with other apps has helped her manage e-commerce sales efficiently. Lee uses Shopify as an e-commerce platform and PayPal as a payment system. By using a version of these apps designed to work with QuickBooks, Lee can import sales data, line items, fees, and taxes, as well as customer information into the accounting program. In addition, Shopify e-commerce data automatically syncs with QuickBooks, allowing her to keep bookkeeping activities to a minimum and giving her more time to focus on designing and creating new products and fulfilling the social goals of her business. According to Lee, a significant part of her operation is dedicated to providing training and jobs to members of the local community. In addition, Future Glory supports various social causes, donating a portion of revenue to various organizations that assist women and children in need. Keeping a close eye on financial and accounting information is an important part of any business, whether it's a startup or a global conglomerate. The continuing revolution in technology has enabled bookkeeping and accounting activities to be done more efficiently while giving business owners, particularly small businesses like Future Glory, the time to spend expanding their business and giving back to their local communities. Sources, corporate profile, https://www, Intuit.com, accessed August 11, 2017, QuickBooks Online, https, QuickBooks, Intuit.com, accessed August 11, 2017, Our Story, https, Future Regulatory. Co, accessed August 10, 2017, It's in the Bag, Future Glory blends apps with QuickBooks to craft fine leather goods, https. QuickBooks, Intuit.com, accessed August 10, 2017, Jordan Cushions, Guide to Dogpatch's Flourishing Design Shops, San Francisco Chronicle, http://www. sfchronicle.com, March 1, 2017, David Leung Photography Blog, November, Theresa Lee, http www. David Liang Photo. Com, November 30, 2016. Financial information is central to every organization. To operate effectively, businesses must have a way to track income, expenses, assets, and liabilities in an organized manner. Financial information is also essential for decision-making. Managers prepare financial reports using accounting, a set of procedures and guidelines for companies to follow when preparing financial reports. Unless you understand basic accounting concepts, you will not be able to speak the standard financial language of businesses. This module examines the role of accounting in business, how accounting contributes to a company's overall success, the three primary financial statements, and careers in accounting. Why are financial reports and accounting information important, and who uses them? Prior to 2001, accounting topics rarely made the news. That changed when Enron Corp.'s manipulation of accounting rules to improve its financial statements hit the front pages of newspapers. The company filed bankruptcy in 2001, and its former top executives were charged with multiple counts of conspiracy and fraud. Arthur Andersen, Enron's accounting firm, was indicted and convicted of obstruction of justice, and in 2002, the once respected firm went out of business. Soon, financial abuses at other companies, among them Tyco, Adelphia, WorldCom, and more recently Madoff Investment Securities, surfaced. Top executives at these and other companies were accused of knowingly flouting accepted accounting standards to inflate current profits and increase their compensation. Many were subsequently convicted. Investment Securities broker Bernard Madoff and his accountant bilked investors out of more than $65 billion. Madoff is currently serving a 150-year prison term. Andrew Fastow, Enron's former chief financial officer, and Ben Glisson Jr., its former treasurer, pleaded guilty and received prison terms of 10 and 5 years, respectively. The company's former chairman, Ken Lay, and CEO, Jeffrey Skilling, were convicted of multiple charges. Bernard Ebbers, WorldCom's CEO, was sentenced to 25 years in prison for conspiracy, securities fraud, and filing false reports with regulatory agencies, crimes that totaled $11 billion in accounting fraud. Tyco's CEO L. Dennis Kozlowski was fined $70 million and sentenced to 8 to 25 years. 1. These and other cases raised critical concerns about the independence of those who audit a company's financial statements, questions of integrity and public trust, and issues with current financial reporting standards. Investors suffered as a result because the crisis in confidence sent stock prices tumbling, and companies lost billions in value. So it's no surprise that more people are paying attention to accounting topics. We now recognize that accounting is the backbone of any business, providing a framework to understand the firm's financial condition. Reading about accounting irregularities, fraud, audit, financial statement, review shortcomings, out-of-control business executives, and bankruptcies, we have become very aware of the importance of accurate financial information and sound financial procedures. All of us, whether we are self-employed, work for a local small business or a multinational Fortune 100 firm, or are not currently in the workforce, benefit from knowing the basics of accounting and financial statements. We can use this information to educate ourselves about companies before interviewing for a job or buying a company's stock or bonds. Employees at all levels of an organization use accounting information to monitor operations. They also must decide which financial information is important for their company or business unit, what those numbers mean, and how to use them to make decisions. The posting reads as follows. Auction. Live, simulcast. Saturday, November 13, 10 a.m. New York Sheraton Hotel and Towers, Metropolitan Ballroom. Jewelry, watches, antiques, art, furniture, all belonging to Bernard and Ruth Madoff. Terms, www.auction.com. Exhibit 14. 2. This advertisement by the U.S. Marshals Service underscores the greed and financial abuse caused by Bernard Madoff, as his personal belongings were seized by the government and auctioned off to help pay for the $65 billion lost by individuals who invested in his financial securities firm. Madoff is serving a jail term of 150 years for his fraudulent actions. What should be the lessons learned by executives and accounting professionals about Madoff's behavior? Credit. PK Flickr Attribution 2, Generic CC by 20. This chapter starts by discussing why accounting is important for businesses and for users of financial information. Then it provides a brief overview of the accounting profession and the post-Enron regulatory environment. Next, it presents an overview of basic accounting procedures, followed by a description of the three main financial statements: the balance sheet, the income statement, and the statement of cash flows. Using these statements, we then demonstrate how ratio analysis of financial statements can provide valuable information about a company's financial condition. Finally, the chapter explores current trends affecting the accounting profession. Accounting basics. Accounting is the process of collecting, recording, classifying, summarizing, reporting, and analyzing financial activities. It results in reports that describe the financial condition of an organization. All types of organizations, businesses, hospitals, schools, government agencies, and civic groups use accounting procedures. Accounting provides a framework for looking at past performance, current financial health, and possible future performance. It also provides a framework for comparing the financial positions and financial performances of different firms. Understanding how to prepare and interpret financial reports will enable you to evaluate two companies and choose the one that is more likely to be a good investment. The accounting system shown in Exhibit 14. 3 converts the details of financial transactions, sales, payments, purchases, and so on, into a form that people can use to evaluate the firm and make decisions. Data become information, which in turn becomes reports. These reports describe a firm's financial position at one point in time and its financial performance during a specified period. Financial reports include financial statements, such as balance sheets and income statements, and special reports, such as sales and expense breakdowns by product line. The illustration shows the first step as classify, summarize, and analyze data. This flows into the step that reads prepare financial reports. This flows into the step that reads use financial reports to evaluate the firm and make decisions. Exhibit 14. 3. The accounting system, attribution. Copyright Rice University, OpenStax, under CC by 40 license. Who uses financial reports? The accounting system generates two types of financial reports, as shown in Exhibit 14. 4. Internal and external. Internal reports are used within the organization. As the term implies, managerial accounting provides financial information that managers inside the organization can use to evaluate and make decisions about current and future operations. For instance, the sales reports prepared by managerial accountants show how well marketing strategies are working, as well as the number of units sold in a specific period of time. This information can be used by a variety of managers within the company and operations, as well as in production or manufacturing to plan future work based on current financial data. Production cost reports can help departments track and control costs, as well as zero in on the amount of labor needed to produce goods or services. In addition, managers may prepare very detailed financial reports for their own use and provide summary reports to top management, providing key executives with a snapshot of business operations in a specific timeframe. Financial accounting focuses on preparing external financial reports that are used by outsiders. That is, people who have an interest in the business but are not part of the company's management. Although they provide useful information for managers, these reports are used primarily by lenders, suppliers, investors, government agencies, and others to assess the financial strength of a business. To ensure accuracy and consistency in the way financial information is reported, accountants in the United States follow generally accepted accounting principles, GAAP, when preparing financial statements. The Financial Accounting Standards Board, FASB, is a private organization that is responsible for establishing financial accounting standards used in the United States. Currently, there are no international accounting standards. Because accounting practices vary from country to country, a multinational company must make sure that its financial statements conform to both its own country's accounting standards and those of the parent company's country. often another country's standards are quite different from US GAAP. In the past, the U.S. Financial Accounting Standards Board and the International Accounting Standards Board, IASB, worked together to develop global accounting standards that would make it easier to compare financial statements of foreign-based companies. However, as of this writing, the two organizations have not agreed on a global set of accounting standards. The diagram shows the accounting system at the center and branching to the left and right. To the left is internal reporting, managerial accounting. To the right is external reporting, financial accounting. On the internal side, the diagram reads as follows: financial reports for internal use by company management, sales reports, production cost reports, and other detailed financial reports. On the external reporting side, the diagram reads as follows: financial statements for use by investors, lenders, and others outside the organization. Balance sheet, income statement, and statement of cash flows. Exhibit 14. 4 reports provided by the accounting system, attribution. Copyright Rice University, OpenStax, under CC by 40 license. Expanding around the globe. Global accounting standards unlikely to happen. Imagine being a CFO of a major multinational company with significant operations in 10 other countries. Because the accounting rules in those countries don't conform to GAAP, your staff has to prepare 9 sets of financial reports that comply with the host country's rules, and also translate the figures to GAAP for consolidation into the parent company's statements in the United States. It's a massive undertaking for anyone. The US FASB and the IASB have tried to make this task easier, but progress has been slow. These groups hope to develop international accounting standards that remove disparities between national and international standards, improve the quality of financial information worldwide, and simplify comparisons of financial statements across borders for both corporations and investors. Unfortunately, it looks like this goal of convergence is slipping away. More than a decade ago, the FASB and the IASB jointly published a Memorandum of Understanding, MOU, reaffirming the two organizations' desire to create uniform global accounting standards. This document underscores our strong commitment to continue to work together with the IASB to bring about a common set of accounting standards that will enhance the quality, comparability, and consistency of global financial reporting, enabling the world's capital markets to operate more effectively, said Robert Hers, FASB's former chairman. Sir David Tweedy, then chairman of the IASB, agreed. The pragmatic approach described in the MOU enables us to provide much-needed stability for companies using IFRS, the IASB's International Financial Reporting Standards. In the near term, he commented, about 150 countries worldwide currently use IFRS. As they worked toward convergence, the board members decided to develop a new set of common standards rather than try to reconcile the two standards. These new standards had to be better than existing ones, not simply eliminate differences. Unfortunately, merging GAAP and IFRS into a consistent set of international accounting standards has proven to be very difficult because of different approaches used in the two sets. For example, because of frequent litigation surrounding financial information in the United States, preparers of financial statements demand very detailed rules in all areas of accounting, in contrast to the IASB's approach of setting accounting principles and leaving preparers to apply them to individual situations they encounter. In addition, many companies doing business in the United States fear that moving toward global accounting standards would be very costly and time-consuming in terms of changing accounting software, employee and vendor training, and other business-related practices. For now, the two organizations agree to disagree on when and if they can converge GAAP and IFRS into a global set of standards. However, they continue to keep each other informed about upcoming changes in standards that may impact accounting practices worldwide. Critical thinking questions: is it important to have a single set of international accounting standards for at least publicly owned companies? Defend your answer. Do you think the two organizations will ever come close to uniform global accounting standards? Use a search engine and the archives of CFO Magazine, http://www CFO. Com to research this topic and summarize your findings. Sources: who uses IFRS standards? http://www. IFRS. Org, accessed August 10, 2017. FASB and IASB reaffirm commitment to enhance consistency, comparability, and efficiency in global capital markets. Press release: http://www. FASB. Org, accessed August 10, 2017. Ken Tysiak, will Brexit Trump affect global accounting standards? http://www. Journal of Accountancy. Com, December 6, 2016. Bruce Cowie, Insights, IFRS US GAAP Convergence and Global Accounting Standards. Where are we now? https://Kaplan. Co. UK, September 26, 2016. Michael Cohn, IASB and FASB look beyond convergence. https://www. Accounting Tade. Com, December 9, 2014. David M. Katz, The Split Over Convergence. CFO, http://www. CFO. Com, October 17, 2014. Financial statements are the chief element of the annual report, a yearly document that describes a firm's financial status. Annual reports usually discuss the firm's activities during the past year and its prospects for the future. 3 primary financial statements included in the annual report are discussed and shown later in this chapter: the balance sheet, the income statement, the statement of cash flows. Concept check: explain who uses financial information. Differentiate between financial accounting and managerial accounting. How do GAAP, the FASB, and the IASB influence the accounting industry? What are the differences between public and private accountants, and how has federal legislation affected their work? When you think of accountants, do you picture someone who works in a back room, hunched over a desk, wearing a green eye shade and scrutinizing pages and pages of numbers? Although today's accountants still must love working with numbers, they now work closely with their clients to not only prepare financial reports, but also help them develop good financial practices. Advances in technology have taken the tedium out of the number crunching and data gathering parts of the job, and now offer powerful analytical tools as well. Therefore, accountants must keep up with information technology trends. The accounting profession has grown due to the increased complexity, size, and number of businesses and the frequent changes in the tax laws. Accounting is now a $95 billion plus industry. The more than 1.4 million accountants in the United States are classified as either public accountants or private corporate accountants. They work in public accounting firms, private industry, education, and government, and about 10% are self-employed. The job outlook for accountants over the next decade is positive. The Bureau of Labor Statistics projects that accounting and auditing jobs will increase 11% faster than many other industries in the U.S. economy. 2. Public accountants, independent accountants who serve organizations and individuals on a fee basis, are called public accountants. Public accountants offer a wide range of services, including preparation of financial statements and tax returns, independent auditing of financial records and accounting methods, and management consulting. Auditing, the process of reviewing the records used to prepare financial statements, is an important responsibility of public accountants. They issue a formal auditor's opinion indicating whether the statements have been prepared in accordance with accepted accounting rules. This written opinion is an important part of a company's annual report. The largest public accounting firms, called the Big Four, operate worldwide and offer a variety of business consulting services in addition to accounting services. In order of size, they are Deloitte, PwC, PricewaterhouseCoopers, EY, Ernst & Young, and KPMG International. 3. A former member of this group, Arthur Anderson, disbanded in 2002 as a result of the Enron scandal. To become a certified public accountant, CPA, an accountant must complete an approved bachelor's degree program and pass a test prepared by the American Institute of CPAs, AICPA. Each state also has requirements for CPAs, such as several years, on-the-job experience, and continuing education. Only CPAs can issue the auditor's opinion on a firm's financial statements. most CPAs first work for public accounting firms and later may become private accountants or financial managers. Of the more than 418,000 accountants who belong to the AICPA, 47% work in public accounting firms and 39% in business and industry. 4. Private accountants, accountants employed to serve one particular organization, are private accountants. Their activities include preparing financial statements, auditing company records to be sure employees follow accounting policies and procedures, developing accounting systems, preparing tax returns, and providing financial information for management decision-making. Whereas some private accountants hold the CPA designation, managerial accountants also have a professional certification program. Requirements to become a certified management accountant, CMA, include passing an examination, reshaping the accounting environment. Although our attention was focused on big-name accounting scandals in the late 1990s and early 2000s, an epidemic of accounting irregularities was also taking place in the wider corporate arena. The number of companies restating annual financial statements grew at an alarming rate, tripling from 1997 to 2002. In the wake of the numerous corporate financial scandals, Congress and the accounting profession took major steps to prevent future accounting irregularities. These measures targeted the basic ways, cited by a report from the AICPA, that companies massaged financial reports through creative, aggressive, or inappropriate accounting techniques, including committing fraudulent financial reporting, stretching accounting rules to significantly enhance financial results, following appropriate accounting rules, but using loopholes to manage financial results. Why did companies willfully push accounting to the edge and over it to artificially pump up revenues and profits? Looking at the companies involved in the scandals, some basic similarities have emerged: a company culture of arrogance and above-average tolerance for risk, interpretation of accounting policies to their advantage and manipulation of the rules to get to a predetermined result and conceal negative financial information, compensation packages tied to financial or operating targets, making executives and managers greedy and pressuring them to find sometimes questionable ways to meet what may have been overly optimistic goals, ineffective checks and balances, such as audit committees, boards of directors, and financial control procedures that were not independent from management, centralized financial reporting that was tightly controlled by top management, increasing the opportunity for fraud, financial performance benchmarks that were often out of line with the company's industry, complicated business structures that clouded how the company made its profits, cash flow from operations that seemed out of line with reported earnings. You'll learn about this important difference between cash and reported earnings in the sections on the income statement and statement of cash flows. Acquisitions made quickly, often to show growth rather than for sound business reasons. Management focused more on buying new companies than making the existing operations more profitable. 5. Companies focused on making themselves look good in the short term, doing whatever was necessary to top past performance and to meet the expectations of investment analysts, who project earnings, and investors, who panic when a company misses the analysts' forecasts. Executives who benefited when stock prices rose had no incentive to question the earnings increases that led to the price gains. These number games raised serious concerns about the quality of earnings and questions about the validity of financial reports. Investors discovered to their dismay that they could neither assume that auditors were adequately monitoring their clients' accounting methods, nor depend on the integrity of published financial information. Better numbers ahead. Over the past 15 years, a number of accounting reforms have been put in place to set better standards for accounting, auditing, and financial reporting. Investors, now aware of the possibility of various accounting shenanigans, are avoiding companies that use complicated financial structures and off-the-books financing. In 2002, the Sarbanes-Oxley Act, commonly referred to as SOX, went into effect. This law, one of the most extensive pieces of business legislation passed by Congress, was designed to address the investing public's lack of trust in corporate America. It redefines the public corporation, auditor relationship, and restricts the types of services auditors can provide to clients. The Act clarifies auditor independence issues places increased accountability on a company's senior executives and management, strengthens disclosure of insider transactions, and employee selling stock based on information not known by the public, and prohibits loans to executives. An independent 5-member public company accounting oversight board, PCAOB, was given the authority to set and amend auditing, quality control, ethics, independence, and other standards for audit reports. The Act specifies that all PCAOB members be financially literate. 2 members must have their CPA designation, and the other 3 cannot be or have been CPAs. Appointed and overseen by the Securities and Exchange Commission, SEC, the PCAOB can also inspect accounting firms, investigate breaches of securities law, standards, competency, and conduct, and take disciplinary action. The corporate board registers public accounting firms, as the Act now requires. Altering or destroying key audit documents now carries felony charges and increased penalties. Other key provisions of the Act cover the following areas. Auditing standards. The board must include in its standards several requirements, such as maintaining audit work papers and other documentation for audit reports for 7 years, the review and approval of audit reports by a second partner, and audit standards for quality control and review of internal control procedures. Financial disclosure. Companies must clearly disclose all transactions that may have a material current or future effect on their financial condition, including those that are off the books or with unconsolidated entities, related companies, whose results the company is not required to combine with its own financial statements under current accounting rules. Management and major stockholders must disclose transactions such as sales of company stock within 2 days of the transaction. The company must disclose its code of ethics for senior financial executives. Any significant changes in a company's operations or financial condition must be disclosed on a rapid and current basis. Financial statement certification. Chief executive officers and chief financial officers must certify company financial statements, with severe criminal and civil penalties for false certification. If securities fraud results in restatement of financial reports, these executives will lose any stock-related profits and bonuses they received prior to the restatement. Internal controls. Each company must have appropriate internal control procedures in place for financial reporting, and its annual report must include a report on implementation of those controls to assure the integrity of financial reports. Consulting work. The Act restricts the non-auditing work auditors may perform for a client. In the past, the large accounting firms had expanded their role to include a wide range of advisory services that went beyond their traditional task of validating a company's financial information. Conflicts of interest arose when the same firm earned lucrative fees for both audit and consulting work for the same client. 6 other regulatory organizations also took steps to prevent future abuses. In September 2002, the AICPA Auditing Standards Board, ASB, issued expanded guidelines to help auditors uncover fraud while conducting audits. The New York Stock Exchange stiffened its listing requirements so that the majority of directors at listed companies must be independent and not employees of the corporation. Nor can auditors serve on clients' boards for 5 years. Companies listed in the NASDAQ marketplace cannot hire former auditors at any level for 3 years. In response to the passage of Sarbanes-Oxley and other regulations, companies implemented new control measures and improved existing ones. The burdens in both cost and time have been considerable. Many companies had to redesign and restructure financial systems to improve efficiency. Some finance executives believe that their investment in increased controls has improved shareholder perceptions of their company's ethics. Others, however, reported that costs depressed earnings and negatively affected stock prices. Despite the changes and costs associated with SOX compliance, 15 years after the law's implementation, many business executives believe that the process has helped them fine-tune financial activities and reporting while addressing dynamic changes in the market and other economic challenges. 7 Concept check. Compare the responsibilities of public and private accountants. How are they certified? Summarize the major changes affecting accounting and corporate reporting and the reasons for them. What are the 6 steps in the accounting cycle? Using generally accepted accounting principles, accountants record and report financial data in similar ways for all firms. They report their findings in financial statements that summarize a company's business transactions over a specified time period. As mentioned earlier, the 3 major financial statements are the balance sheet, income statement, and statement of cash flows. People sometimes confuse accounting with bookkeeping. Accounting is a much broader concept. Bookkeeping, the system used to record a firm's financial transactions, is a routine, clerical process. Accountants take bookkeepers, transactions, classify and summarize the financial information, and then prepare and analyze financial reports. Accountants also develop and manage financial systems and help plan the firm's financial strategy. The accounting equation, the accounting procedures used today, are based on those developed in the late 15th century by an Italian monk, Brother Luca Pacioli. He defined the 3 main accounting elements as assets, liabilities, and owner's equity. Assets are things of value owned by a firm. They may be tangible, such as cash, equipment, and buildings, or intangible, such as a patent or trademarked name. Liabilities, also called debts, are what a firm owes to its creditors. Owner's equity is the total amount of investment in the firm minus any liabilities. Another term for owner's equity is net worth. The relationship among these 3 elements is expressed in the accounting equation. Assets minus liabilities equals owner's equity. The accounting equation must always be in balance. That is, the total of the elements on one side of the equals sign must equal the total on the other side. Suppose you start a coffee shop and put $10,000 in cash into the business. At that point, the business has assets of $10,000 and no liabilities. This would be the accounting equation. Assets $10, 000 equals liabilities $0 plus owner's equity $10, 000 the liabilities are 0 and owner's equity. The amount of your investment in the business is $10,000. The equation balances. To keep the accounting equation in balance, every transaction must be recorded as 2 entries. As each transaction is recorded, there is an equal and opposite event so that 2 accounts or records are changed. This method is called double entry bookkeeping. Suppose that after starting your business with $10,000 cash, you borrow another $10,000 from the bank. The accounting equation will change as follows. Assets $10, 000 $10, 000 $20, 000 equals liabilities $0 $10, 000 $10, 0 plus owner's equity $10, 000 $0 $10, 0 initial equation borrowing transaction equation. After borrowing now, you have $20. 0 in assets, your $10, $0 in cash, and the $10, $0 loan proceeds from the bank. The bank loan is also recorded as a liability of $10,000 because it's a debt you must repay. Making 2 entries keeps the equation in balance. The accounting cycle refers to the process of generating financial statements, beginning with a business transaction and ending with the preparation of the report. Exhibit 14.5 shows the 6 steps in the accounting cycle. The first step in the cycle is to analyze the data collected from many sources. All transactions that have a financial impact on the firm, sales, payments to employees and suppliers, interest and tax payments, purchases of inventory, and the like, must be documented. The accountant must review the documents to make sure they're complete. Step 1. Analyze business transaction documents. Step 2. Record business transactions in journal. Step 3. Post journal entries to ledgers. Step 4. Prepare trial balance. Step 5. Prepare financial statements and management reports from account data. Step 6. Analyze reports. Exhibit 14.5 The accounting cycle attribution. Copyright Rice University, OpenStax, under CC by 40 license. Next, each transaction is recorded in a journal, a listing of financial transactions in chronological order. The journal entries are then recorded in ledgers, which show increases and decreases in specific asset, liability, and owner's equity accounts. The ledger totals for each account are summarized in a trial balance, which is used to confirm the accuracy of the figures. These values are used to prepare financial statements and management reports. Finally, individuals analyze these reports and make decisions based on the information in them. Photograph shows a screenshot of a QuickBooks page with columns and rows of data. Exhibit 14. 6 QuickBooks is a well-known software developer that provides business management solutions to businesses of different sizes. The company's accounting software tools benefit professionals by automating a broad range of accounting and other business tasks. QuickBooks has become standard in the accounting and business fields, assisting in managerial decision-making and streamlining bookkeeping and accounting processes. What accounting functions are typically incorporated into basic accounting software programs? Credit, Mark Smith Flickr / attribution 2 generic CC by 2. 0. Technological advances over the past decade. Technology has had a significant impact on the accounting industry. Computerized and online accounting programs now do many different things to make business operations and financial reporting more efficient. For example, most accounting packages offer basic modules that handle general ledger, sales order, accounts receivable, purchase order, accounts payable, and inventory control functions. Tax programs use accounting data to prepare tax returns and tax plans. Point-of-sale terminals used by many retail firms automatically record sales and do some of the bookkeeping. The Big Four and many other large public accounting firms develop accounting software for themselves and for clients. Accounting and financial applications typically represent one of the largest portions of a company's software budget. Accounting software ranges from off-the-shelf programs for small businesses to full-scale customized enterprise resource planning systems for major corporations. Although these technological advances in accounting applications have made the financial aspects of running a small business much easier, entrepreneurs and other small business owners should take the time to understand underlying accounting principles, which play an important role in evaluating just how financially sound a business enterprise really is. Managing change data analytics become effective CPA tool knowledge is power, and understanding what your customers want and how your company can provide it often differentiates you from the competition. As the accounting field continues to take advantage of technological advances, it is important that data analytics become a key element of any accounting professional's toolbox. Historically described as paper pushers who track financial information, today's accountants need to learn about big data and data analytics as part of their continuing education. Not long ago, an accountant's work finished when business financial statements were finalized and tax forms were ready to be filed with federal, state, and local governing bodies. Not anymore. With the revolution of computer technology, automation, and data collection from a myriad of sources, accountants can use data analytics to provide a clearer picture of the overall business environment for their companies and clients on an ongoing basis. Data analytics can be defined as the process of examining numerous data sets, sometimes called big data, to draw conclusions about the information they contain with the assistance of specialized systems and software. Using data analytics effectively can help businesses increase revenue, expand operations, maximize customer service, and more. Accountants can use data analytics to make more accurate and detailed forecasts, help companies link diverse financial and non-financial data sets, which provides a more comprehensive reporting of their overall performance to shareholders and others, assess and manage risk across the entire organization, and identify possible fraud. Data analytics can also improve and enhance the auditing process because more information will now be collected, which allows for analysis of full data sets in situations where only samples were audited previously. In addition, continuous monitoring will be easier to accomplish using data sets that are comprehensive. Accounting professionals who can adapt to quickly changing technology, such as data analytics, will not only expand the scope of their expertise, but also provide financial guidance that will give their companies and clients a strong strategic advantage over competitors. Critical thinking questions: how can accountants use data analytics to enhance the services they provide to their clients? Is the seismic shift in technology a good thing for professional accountants? Explain your reasoning. Sources: Data Analytics, HTTP, Search Data Management. TechTarget.com, accessed August 11, 2017. Jiley Tang and Konkar E. Karim, Big Data in Business Analytics. Implications for the Audit Profession. The CPA Journal, http://www. CPAJournal.com, June 2017 issue. Clarence Go, Are You Ready? Data Analytics is Reshaping the Work of Accountants. https://www. CFOinnovation.com, February 28, 2017. Norbert T. Schackert, Julia Kakina, Stephen Kozlowski, and Miklos Vassarhelyi, The Next Frontier in Data Analytics. Journal of Accountancy, http://www. Journal of Accountancy.com, August 1, 2016. Concept Check Explain the Accounting Equation. Describe the 6-step accounting cycle. What role do computers and other technology play in accounting? In what terms does the balance sheet describe the financial condition of an organization? The balance sheet, one of 3 financial statements generated from the accounting system, summarizes a firm's financial position at a specific point in time. It reports the resources of a company, assets, the company's obligations, liabilities, and the difference between what is owned, assets, and what is owed, liabilities, or owner's equity. The assets are listed in order of their liquidity, the speed with which they can be converted to cash. The most liquid assets come first, and the least liquid are last. Because cash is the most liquid asset, it is listed first. Buildings, on the other hand, have to be sold to be converted to cash, so they are listed after cash. Liabilities are arranged similarly. Liabilities due in the short term are listed before those due in the long term. The balance sheet as of December 31, 2018, for Delicious Desserts, Inc., a fictitious bakery, is illustrated in Table 14. 1. The basic accounting equation is reflected in the 3 totals highlighted on the balance sheet. Assets of $148,900 equal the sum of liabilities and owners. Equity: $70,150 plus $78,750. The 3 main categories of accounts on the balance sheet are explained below. Balance sheet for Delicious Desserts, Inc. Balance sheet as of December 31, 2018. Assets, current assets. Cash, marketable securities, accounts receivable less. Allowance for doubtful accounts, notes receivable, inventory total. Current assets, $45,000, $1,300, $15,000, $4,540, $3,705, $1,000, $15,080, $3,200. Fixed assets. Bakery equipment less. Accumulated depreciation, furniture and fixtures less. Accumulated depreciation total, fixed assets, intangible assets. Trademark, goodwill total, intangible assets total, assets $56, $0 $16, $0 $18, $454, $250 $40, $0 $14, $204, $507, $0 $54, $211, $500, $148. 900 Liabilities and owners. Equity, current liabilities. Accounts payable, notes payable, accrued expenses, income taxes, payable, current portion of long-term debt total, current liabilities, $30,650, $15,000, $4,500, $5,000, $5,000, $60,150, long-term liabilities. Bank loan for bakery equipment, total long-term liabilities, $10,000, $10,000, $70,150. Owners, equity. Common stock, 10,000 shares outstanding, retained earnings, total owners. Equity, total liabilities and owners. Equity, $30,040, $8,750, $70, $8,750, $148,900. Table 14. 1. Assets can be divided into 3 broad categories: current assets, fixed assets, and intangible assets. Current assets are assets that can or will be converted to cash within the next 12 months. They are important because they provide the funds used to pay the firm's current bills. They also represent the amount of money the firm can quickly raise. Current assets include cash, funds on hand, or in a bank, marketable securities. temporary investments of excess cash that can readily be converted to cash accounts receivable. Amounts owed to the firm by customers who bought goods or services on credit notes receivable. Amounts owed to the firm by customers or others to whom it lent money. Inventory. Stock of goods being held for production or for sale to customers. Fixed assets are long-term assets used by the firm for more than a year. They tend to be used in production and include land, buildings, machinery, equipment, furniture, and fixtures. Except for land, fixed assets wear out and become outdated over time. Thus, they decrease in value every year. This declining value is accounted for through depreciation. Depreciation is the allocation of the asset's original cost to the years in which it is expected to produce revenues. A portion of the cost of a depreciable asset, a building or piece of equipment, for instance, is charged to each of the years in which it is expected to provide benefits. This practice helps match the asset's cost against the revenues it provides. Because it is impossible to know exactly how long an asset will last, estimates are used. They are based on past experience with similar items or IRS guidelines for assets of that type. Notice that, through 2018, Delicious Desserts has taken a total of $16,000 in depreciation on its bakery equipment. Intangible assets are long-term assets with no physical existence. Common examples are patents, copyrights, trademarks, and goodwill. Patents and copyrights shield the firm from direct competition, so their benefits are more protective than productive. For instance, no one can use more than a small amount of copyrighted material without permission from the copyright holder. Trademarks are registered names that can be sold or licensed to others. One of Delicious Desserts' intangible assets is a trademark valued at $4,500. Goodwill occurs when a company pays more for an acquired firm than the value of its tangible assets. Delicious Desserts' other tangible asset is goodwill of $7,000. Liabilities are the amounts a firm owes to creditors. Those liabilities coming due sooner, current liabilities, are listed first on the balance sheet, followed by long-term liabilities. Current liabilities are those due within a year of the date of the balance sheet. These short-term claims may strain the firm's current assets because they must be paid in the near future. Current liabilities include accounts payable, amounts the firm owes for credit purchases due within a year. This account is the liability counterpart of accounts receivable. Notes payable, short-term loans from banks, suppliers, or others that must be repaid within a year. For example, Delicious Desserts has a 6-month, $15,000 loan from its bank that is a note payable. Accrued expenses. Expenses, typically for wages and taxes, that have accumulated and must be paid at a specified future date within the year, although the firm has not received a bill. Income taxes payable. Taxes owed for the current operating period, but not yet paid. Taxes are often shown separately when they are a large amount. Current portion of long-term debt, any repayment on long-term debt due within the year. Delicious Desserts is scheduled to repay $5,000 on its equipment loan in the coming year. Long-term liabilities come due more than 1 year after the date of the balance sheet. They include bank loans, such as Delicious Desserts, $10,000 loan for bakery equipment, mortgages on buildings, and the company's bonds sold to others. Owners, equity owners. Equity is the owner's total investment in the business after all liabilities have been paid. For sole proprietorships and partnerships, amounts put in by the owners are recorded as capital. In a corporation, the owners provide capital by buying the firm's common stock. For Delicious Desserts, the total common stock investment is $30,000. Retained earnings are the amounts left over from profitable operations since the firm's beginning. They are total profits minus all dividends, distributions of profits, paid to stockholders. Delicious Desserts has $48,750 in retained earnings. Concept check: what is a balance sheet? What are the 3 main categories of accounts on the balance sheet, and how do they relate to the accounting equation? How do retained earnings relate to owners' equity? How does the income statement report a firm's profitability? The balance sheet shows the firm's financial position at a certain point in time. The income statement summarizes the firm's revenues and expenses and shows its total profit or loss over a period of time. Most companies prepare monthly income statements for management and quarterly and annual statements for use by investors, creditors, and other outsiders. The primary elements of the income statement are revenues, expenses, and net income, or net loss. The income statement for Delicious Desserts for the year ended December 31, 2018, is shown in Table 14. 2. Income statement for Delicious Desserts, Inc. Income statement for the year ending December 31, 2018, revenues gross sales $275,000 less. Sales discounts $2,500 less. Returns and allowances $2,000 net sales $270,500. Cost of goods sold beginning inventory. January 1, $18,000. Cost of goods manufactured $109,500. Total cost of goods available for sale $127,500 less. Ending inventory December 31, 15. 0 cost of goods sold $112,500. Gross profit $158. 0 operating expenses, selling expenses, sales salaries $31. $0 advertising $16. 0 other selling expenses $18. 0 total selling expenses $65. $0 general and administrative expenses, professional and office salaries $20. $500 utilities $5. 0 office supplies $1. $500 interest $3. $600 insurance $2. $500 rent $17. 0 total general and administrative expenses $50. $100 total operating expenses $115. $100 net profit before taxes $42. $900 less. Income taxes $10,725. Net profit $32,175. Table 14. 2 revenues. Revenues are the dollar amount of sales plus any other income received from sources such as interest, dividends, and rents. The revenues of Delicious Desserts arise from sales of its bakery products. Revenues are determined starting with gross sales, the total dollar amount of a company's sales. Delicious Desserts had 2 deductions from gross sales. Sales discounts are price reductions given to customers that pay their bills early. For example, Delicious Desserts gives sales discounts to restaurants that buy in bulk and pay at delivery. Returns and allowances is the dollar amount of merchandise returned by customers because they didn't like a product or because it was damaged or defective. Net sales is the amount left after deducting sales discounts and returns and allowances from gross sales. Delicious Desserts, gross sales were reduced by $4,500, leaving net sales of $270,500. Expenses are the costs of generating revenues. 2 types are recorded on the income statement: cost of goods sold and operating expenses. The cost of goods sold is the total expense of buying or producing the firm's goods or services. For manufacturers, cost of goods sold includes all costs directly related to production. Purchases of raw materials and parts, labor and factory overhead, utilities, factory maintenance, machinery repair. For wholesalers and retailers, it is the cost of goods bought for resale. For all sellers, cost of goods sold includes all the expenses of preparing the goods for sale, such as shipping and packaging. Delicious Desserts, cost of goods sold is based on the value of inventory on hand at the beginning of the accounting period, $18,000. During the year, the company spent $109,500 to produce its baked goods. This figure includes the cost of raw materials, labor costs for bakery workers, and the cost of operating the bakery area. Adding the cost of goods manufactured to the value of beginning inventory, we get the total cost of goods available for sale, $127,500. To determine the cost of goods sold for the year, we subtract the cost of inventory at the end of the period. $127,500 minus $15,000 equals $112,500, the amount a company earns after paying to produce or buy its products, but before deducting operating expenses is the gross profit. It is the difference between net sales and cost of goods sold. Because service firms do not produce goods, their gross profit equals net sales. Gross profit is a critical number for a company because it is the source of funds to cover all the firm's other expenses. The other major expense category is operating expenses. These are the expenses of running the business that are not related directly to producing or buying its products. The two main types of operating expenses are selling expenses and general and administrative expenses. Selling expenses are those related to marketing and distributing the company's products. They include salaries and commissions paid to salespeople and the costs of advertising, sales supplies, delivery, and other items that can be linked to sales activity, such as insurance, telephone and other utilities, and postage. General and administrative expenses are the business expenses that cannot be linked to either cost of goods sold or sales. Examples of general and administrative expenses are salaries of top managers and office support staff, utilities, office supplies, interest expense, fees for accounting, consulting, and legal services, insurance, and rent. Delicious desserts, operating expenses totaled $115,100. Net profit or loss, the final figure, or bottom line, on an income statement is the net profit, or net income, or net loss. It is calculated by subtracting all expenses from revenues. If revenues are more than expenses, the result is a net profit. If expenses exceed revenues, a net loss results. Several steps are involved in finding net profit or loss. These are shown in the right-hand column of Table 14. 2. First, cost of goods sold is deducted from net sales to get the gross profit. Then total operating expenses are subtracted from gross profit to get the net profit before taxes. Finally, income taxes are deducted to get the net profit, as shown in Table 14. 2. Delicious Desserts earned a net profit of $32,175 in 2018. It is very important to recognize that profit does not represent cash. The income statement is a summary of the firm's operating results during some time period. It does not present the firm's actual cash flows during the period. Those are summarized in the statement of cash flows, which is discussed briefly in the next section. Concept check: what is an income statement? How does it differ from the balance sheet? Describe the key parts of the income statement. Distinguish between gross sales and net sales. How is net profit or loss calculated? Why is the statement of cash flows an important source of information? Net profit or loss is one measure of a company's financial performance. However, creditors and investors are also keenly interested in how much cash a business generates and how it is used. The statement of cash flows, a summary of the money flowing into and out of a firm, is the financial statement used to assess the sources and uses of cash during a certain period, typically 1 year. All publicly traded firms must include a statement of cash flows in their financial reports to shareholders. The statement of cash flows tracks the firm's cash receipts and cash payments. It gives financial managers and analysts a way to identify cash flow problems and assess the firm's financial viability. Photograph shows a Coinstar machine beside a cash for gift cards machine. Exhibit 14. 7. Coinstar is a cash cow, literally. The company established a niche counting loose change at the exits of supermarkets and other retailers everywhere. For a small fee, Coinstar's coin counting machines turn penny jars and piggy banks into cash vouchers, a no-fee e-gift card, or a charity donation. Recently, Coinstar's parent company, Outerwall, was acquired by a private equity firm in a $16 billion deal to take the holding company private. What does the statement of cash flows indicate about a company's financial status? Credit, Mike Mozart /Flickr attribution 2, generic, CC by 20. Using income statement and balance sheet data, the statement of cash flows divides the firm's cash flows into 3 groups. Cash flow from operating activities, those related to the production of the firm's goods or services. Cash flow from investment activities, those related to the purchase and sale of fixed assets. Cash flow from financing activities, those related to debt and equity financing. Delicious Desserts, statement of cash flows for 2018 is presented in Table 14. 3. It shows that the company's cash and marketable securities have increased over the last year. And during the year, the company generated enough cash flow to increase inventory and fixed assets and to reduce accounts payable, accruals, notes payable, and long-term debt. Statement of cash flows for Delicious Desserts. Delicious Desserts, Inc. Statement of cash flows for 2018. Cash flow from operating activities. Net profit after taxes $32, $175. Depreciation $500. Decrease in accounts receivable $140. Increase in inventory $500. Decrease in accounts payable $65. Decrease in accruals $135. Cash provided by operating activities $29. $215. Cash flow from investment activities. Increase in gross fixed assets $5, $0. Cash used in investment activities $5. 0. Cash flow from financing activities. Decrease in notes payable $3, $0. Decrease in long-term debt $10. Cash used by financing activities $4. 0. Net increase in cash and marketable securities $20. $215. Table 14. 3. Concept check. What is the purpose of the statement of cash flows? Why has cash flow become such an important measure of a firm's financial condition? What situations can you cite from the chapter that support your answer? How can ratio analysis be used to identify a firm's financial strengths and weaknesses? Individually, the balance sheet, income statement, and statement of cash flows provide insight into the firm's operations, profitability, and overall financial condition. By studying the relationships among the financial statements, however, one can gain even more insight into a firm's financial condition and performance. A good way to think about analyzing financial statements is to compare it a fitness trainer putting clients through various well-established assessments and metrics to determine whether a specialized fitness program is paying dividends for the person in terms of better strength, endurance, and overall health. Financial statements at any given time can provide a snapshot of a company's overall health. Company management must use certain standards and measurements to determine whether they need to implement additional strategies to keep the company fit and making a profit. Ratio analysis involves calculating and interpreting financial ratios, using data taken from the firm's financial statements in order to assess its condition and performance. A financial ratio states the relationship between financial data on a percentage basis. For instance, current assets might be viewed relative to current liabilities or sales relative to assets. The ratios can then be compared over time, typically 3 to 5 years. A firm's ratios can also be compared to industry averages or to those of another company in the same industry. Period-to-period and industry ratios provide a meaningful basis for comparison, so that we can answer questions such as, is this particular ratio good or bad? It's important to remember that ratio analysis is based on historical data and may not indicate future financial performance. Ratio analysis merely highlights potential problems. It does not prove that they exist. However, ratios can help managers monitor the firm's performance from period to period to understand operations better and identify trouble spots. Ratios are also important to a firm's present and prospective creditors, lenders, who want to see if the firm can repay what it borrows and assess the firm's financial health. Often loan agreements require firms to maintain minimum levels of specific ratios. Both present and prospective shareholders use ratio analysis to look at the company's historical performance and trends over time. Ratios can be classified by what they measure: liquidity, profitability, activity, and debt. Using Delicious Desserts' 2018 balance sheet and income statement, Table 14. 1 and Table 14. 2. We can calculate and interpret the key ratios in each group. Table 14. 4 summarizes the calculations of these ratios for Delicious Desserts. We'll now discuss how to calculate the ratios and, more important, how to interpret the ratio value. Liquidity ratios. Liquidity ratios measure the firm's ability to pay its short-term debts as they come due. These ratios are of special interest to the firm's creditors. The three main measures of liquidity are the current ratio, the acid test quick ratio, and net working capital. The current ratio is the ratio of total current assets to total current liabilities. Traditionally, a current ratio of $2 of current assets for every $1 of current liabilities has been considered good. Whether it is sufficient depends on the industry in which the firm operates. Public utilities, which have a very steady cash flow, operate quite well with a current ratio well below 2. A current ratio of 2 might not be adequate for manufacturers and merchandisers that carry high inventories and have lots of receivables. The current ratio for delicious desserts for 2018, as shown in Table 14. 4 is 1:4. This means little without a basis for comparison. If the analyst found that the industry average for small bakeries was 2:4, delicious desserts would appear to have low liquidity. The acid test, quick, ratio is like the current ratio except that it excludes inventory, which is the least liquid current asset. The acid test ratio is used to measure the firm's ability to pay its current liabilities without selling inventory. The name acid test implies that this ratio is a crucial test of the firm's liquidity. An acid test ratio of at least 1 is preferred. But again, what is an acceptable value varies by industry. The acid test ratio is a good measure of liquidity when inventory cannot easily be converted to cash, for instance, if it consists of very specialized goods with a limited market. If inventory is liquid, the current ratio is better. Delicious desserts, acid test ratio for 2018 is 1:1. Because the bakery's products are perishable, it does not carry large inventories. Thus, the values of its acid test and current ratios are fairly close. At a manufacturing company, however, inventory typically makes up a large portion of current assets, so the acid test ratio will be lower than the current ratio. Ratio analysis for delicious desserts at year-end 2018. Ratio formula calculation result. Liquidity ratios. Current ratio total, current assets total current liabilities. 83, $200, 60, 150. 1. 4. Acid test, quick, ratio total current assets, inventory total current liabilities. 83, 200 minus $15, 000, $60, 150. 1. 1. Net working capital total current assets, total current liabilities. 83, 200 minus $60, 150, $23,050. Profitability ratios. Net profit margin, net profit, net sales. 32, $175, 270, 500. 11, 9%. Return on equity, net profit total owners' equity. 32, $175, 78, 750. 40, 9%. Earnings per share, net profit number of shares of common stock outstanding. 3,217,510,000. $3. 22. Activity ratio. Inventory turnover, cost of goods sold, average inventory. Cost of goods sold, beginning inventory plus ending inventory, /2. 112, $500, 18, 000 plus $15, 000, /2. 112, $500, 16, 500. 6. 8 times. Debt ratio. Debt to equity ratio total liabilities owners' equity. 70, $150, 78, 750. 89, 1%. Table 14. 4. Net working capital, though not really a ratio, is often used to measure a firm's overall liquidity. It is calculated by subtracting total current liabilities from total current assets. Delicious desserts, net working capital for 2018 is $23,050. Comparisons of net working capital over time often help in assessing a firm's liquidity. Profitability ratios. To measure profitability, a firm's profits can be related to its sales, equity, or stock value. Profitability ratios measure how well the firm is using its resources to generate profit and how efficiently it is being managed. The main profitability ratios are net profit margin, return on equity, and earnings per share. The ratio of net profit to net sales is the net profit margin, also called return on sales. It measures the percentage of each sales dollar remaining after all expenses, including taxes, have been deducted. Higher net profit margins are better than lower ones. The net profit margin is often used to measure the firm's earning power. Good net profit margins differ quite a bit from industry to industry. A grocery store usually has a very low net profit margin, perhaps below 1%, whereas a jewelry store's net profit margin would probably exceed 10%. Delicious Desserts' net profit margin for 2018 is 11.9%. In other words, Delicious Desserts is earning 11.9 cents on each dollar of sales. Photograph shows the brightly lit entrance to a Macy's department store. Exhibit 14. 8 For giant retailers such as Macy's, the high expense of operating a brick-and-mortar store counters the elevated markup on merchandise, resulting in slim profit margins. Because competition forces marketers to keep prices low, it is often a retailer's cost-cutting strategy, not initial markup or sales volume, that determines whether a business will be profitable. What expenses other than payroll and the cost of merchandise affect a retailer's net profit margin? Credit. Mike Mozart /Flickr attribution 2 generic CC by 2. 0. The ratio of net profit to total owners' equity is called return on equity (ROE). It measures the return that owners receive on their investment in the firm, a major reason for investing in a company's stock. Delicious Desserts has a 40.9% ROE for 2018. On the surface, a 40.9% ROE seems quite good, but the level of risk in the business and the ROE of other firms in the same industry must also be considered. The higher the risk, the greater the ROE investors look for. A firm's ROE can also be compared to past values to see how the company is performing over time. Earnings per share, EPS, is the ratio of net profit to the number of shares of common stock outstanding. It measures the number of dollars earned by each share of stock. EPS values are closely watched by investors and are considered an important sign of success. EPS also indicates a firm's ability to pay dividends. Note that EPS is the dollar amount earned by each share, not the actual amount given to stockholders in the form of dividends. Some earnings may be put back into the firm. Delicious Desserts' EPS for 2018 is $3.22. Activity ratios. Activity ratios measure how well a firm uses its assets. They reflect the speed with which resources are converted to cash or sales. A frequently used activity ratio is inventory turnover. The inventory turnover ratio measures the speed with which inventory moves through the firm and is turned into sales. It is calculated by dividing cost of goods sold by the average inventory. Average inventory is estimated by adding the beginning and ending inventories for the year and dividing by 2. Based on its 2018 financial data, Delicious Desserts' inventory, on average, is turned into sales 6-8 times each year, or about once every 54 days, 365 days 6.8. The acceptable turnover ratio depends on the line of business. A grocery store would have a high turnover ratio, maybe 20 times a year, whereas the turnover for a heavy equipment manufacturer might be only 3 times a year. Debt ratios. Debt ratios measure the degree and effect of the firm's use of borrowed funds, debt, to finance its operations. These ratios are especially important to lenders and investors. They want to make sure the firm has a healthy mix of debt and equity. If the firm relies too much on debt, it may have trouble meeting interest payments and repaying loans. The most important debt ratio is the debt-to-equity ratio. The debt-to-equity ratio measures the relationship between the amount of debt financing, borrowing, and the amount of equity financing, owners' funds. It is calculated by dividing total liabilities by owners' equity. In general, the lower the ratio, the better. But it is important to assess the debt-to-equity ratio against both past values and industry averages. Delicious Desserts' ratio for 2018 is 89.1%. The ratio indicates that the company has 89 cents of debt for every dollar the owners have provided. A ratio above 100% means the firm has more debt than equity. In such a case, the lenders are providing more financing than the owners. Concept check. How can ratio analysis be used to interpret financial statements? Name the main liquidity and profitability ratios and explain what they indicate. What kinds of information do activity ratios give? Why are debt ratios of concern to lenders and investors? What major trends affect the accounting industry today? The post-SOX business environment has brought many changes to the accounting profession. When the public accounting industry could no longer regulate itself back in the late 1990s and early 2000s, it became subject to formal regulation for the first time. This regulatory environment set higher standards for audit procedures, which actually helped public companies fine-tune their financial reporting procedures, despite the added costs and labor hours needed to comply with SOX. Once again, the core auditing business, rather than financial advisory and management consulting services, became the primary focus of public accounting firms. The relationship between accountants and their clients has also changed, and the role of chief audit executive has taken on more visibility in many large organizations. In addition, the FASB has made slow but steady progress in making changes related to GAAP, including a separate decision-making framework for users and preparers of private company financial statements. 8. There are several other important trends that may affect the accounting industry over the next several years, including cloud computing services, automation, and staffing challenges. Cloud-based services, the internet and cloud technology, continue to disrupt many industries, including accounting, and clients expect their accountants to be up to speed on how financial data and other accounting information can be entered, accessed, and discussed in a very short period of time. For the most part, gone are the days when accountants and their support staff spend hours manually inputting data that gets rehydrated into standardized accounting and financial statements, and reams of paper generate a company's weekly, monthly, or yearly reports. According to recent research, cloud-based accounting firms add 5 times more clients than traditional accounting firms because businesses expect their accountants to be able to use technology to create the company's financial picture in real time, while assisting them in decision-making about where to go next in terms of profitability, sales, expansion, etc. In addition, it is estimated that more than 90% of small and medium-sized companies use cloud-based accounting software, which helps them synthesize the information they collect for their many important financial statements. This use of computerized accounting programs offers many opportunities to accountants to shift their focus when it comes to attracting and retaining business clients. 9. Automation. In addition to cloud-based services, automation will continue to play an important role in the accounting industry, particularly in auditing services, where the manual gathering and inputting of information can be an inefficient and sometimes inaccurate process. Being able to automate this process will help generate complete sets of data that will improve the overall details of the auditing process. In addition, accountants who can use a client's data files from their business operations and import this information into a tax or accounting software package will streamline the overall accounting process and lessen the tedious work of data entry. 10. Staffing challenges. As these and other disruptive technologies change the focus of accounting work, the challenge of hiring the right staff to use these new tools intensifies. With accounting processes becoming automated and less time-intensive, some accounting firms are becoming more connected to their clients and increasing their advisory services when it comes to daily business operations. This change in approach will likely have an impact on the type of experienced employees accountants hire in the future. In addition, because most services are now cloud-based and financial data is available rather quickly, businesses are apt to change accounting firms faster than in the past if they are unsatisfied with the services they receive. Accountants have a great opportunity to expand their business portfolios and increase their client list by leveraging technology as part of their overall corporate strategies. 11. Managing change. Attracting and retaining millennial CPAs. Much has been written about millennials, the population segment born between 1980 and 2000. As the older baby boomer generation continues to retire, millennials now make up the largest group in the U.S. labor force. This group will continue to shape the workplace over the next few decades. Businesses and other organizations cannot ignore this group and their expectations about employment. To be successful, today's accounting firms, whether Big Four firms or small and mid-sized businesses, need to understand what makes millennials tick, what is important to them, what makes them look for new opportunities both within and outside the organization, and how to retain them. Global Accounting Services Company, PwC, recently partnered with several other institutions to conduct a 2-year generational study about the attitudes of millennial employees. Key findings suggest that millennials want flexibility in their work, lives that leads to an enjoyable work-life balance, appreciation for the work they accomplish, challenges that will help them grow in their careers, and continued support from employers. As a result of this study, PwC made several changes to its own work environment to attract and retain millennial workers, including flexible schedules, relaxed dress codes, greater communication at all levels of the company, and a renewed commitment to transparency within the organization. PwC is not alone in shifting its organizational culture to address some of the issues millennials say are important factors for them within the work environment. For example, Baker Tilly, another top accounting firm, recognizes that more than half its workforce consists of millennials who have helped shape the company's approach to work. The themes of flexibility and trust permeate the company's culture, which reinforces employees' motivation to be engaged in work that is meaningful, satisfying, and helps them develop as individuals. Here are some other strategies accounting firms might employ to keep their 30-something employees from jumping ship. Initiate onboarding activities quickly. Although training accounting professionals takes time, companies should engage and train new employees quickly to immerse them in organizational culture and assign them work they view as meaningful. Assign mentors from the start. Millennials want to know their work makes a difference, so what better way to get them involved right from the start than to make sure they are connected to mentors who can guide their work and career path. Support a flexible approach to work. Some millennials are in the prime of their career, and many may also be juggling a family life that requires a lot of their time. Companies need to remember that millennials like being productive, although they may not think a long workday equates to a productive one. The use of cloud-based technology encourages employees to do their work in a productive atmosphere that may not take place in the office. Recognizing generational traits of millennials not only demonstrates commitment on the part of the company, but also helps keep these employees engaged and involved in their work. Critical thinking questions. Do you think a shift in thinking when it comes to managing millennials is a smart strategy? Why or why not? Will accounting firms be required to rethink their billing strategies to address millennials' insistence on a more flexible approach to work? Explain your reasoning. Sources: Workforce of the Future, The Competing Forces Shaping 2030, https://www.pwc.com, accessed August 11, 2017. Hitendra Patel, The 7 Experiences Millennials Want from Your Firm, http://www.cpatronlines.com, accessed August 11, 2017. Millennial Accountants Don't Want a Corner Office with a View, https://www.roderickpairview.com, April 24, 2017. David Isaacs, Voices. Confessions of a Millennial CPA, The Most Productive Generation, https://www.accountingtade.com, April 20, 2017. Terry Saylor, How CPA Firms Are Evolving to Meet Millennials' Desires, http://www.journalofaccountancy.com, March 6, 2017. Concept Check, How has the relationship between public accounting firms and their clients changed since SOX became law? Describe how cloud computing and automation are changing the accounting industry. What are some of the challenges encountered by accounting firms when introducing new technologies into their workflow process?